Welcome to America's Commercial Real Estate Show, your source for intel, forecasts, and success strategies. Hello, I'm Michael Bull, and we appreciate you being with us. This segment is brought to you by Apto. This is the perfect CRM for your commercial real estate business. Visit apto.com. Today we have an incredible show for you. We're going to call the show The Trump Effect on Economy and Commercial Real Estate. You know, we've had a lot of changes in the economy, and whether you're pro-Trump or anti-Trump, there has been a lot of changes in the tax rates, and what's it mean for commercial real estate? If you look at Wayne Gretzky's famous line, skate where the puck is going. In commercial real estate, that's what we're trying to do. While the past is interesting, we want to get an idea of the economy, the tax rates, the deregulations, immigration, repatriation. There's just so much that's really going on. Well, how's it going to impact the cycle, the length of the cycle, interest rates, and our commercial real estate decisions? Whether you use commercial real estate for your business, and most do, or you're an investor or advise those, we have a great show for you. Please welcome my first guest. It's David Kessler. David is National Director of Real Estate Industry Practice at CohnReznick, and he's joining us on Skype. David, thanks for being with us.
Hey, Michael, thanks for having me.
Well, David, it's really a remarkable time, isn't it, when you think about the potential impact on commercial real estate with all the tax changes and the deregulation, repatriation. Do you expect really more impact from all of this on commercial real estate than we've seen in past history?
I think the tax code really favors commercial real estate, and with repatriation in general, I think there's a lot of good that can happen with the economy. The prediction is that GDP is going to rise, but the question is, at what cost, and are we going to start seeing some inflation because of the adding to the deficit? But you look at repatriation, there's hundreds of billions of dollars offshore. Just Apple and Microsoft alone, 250 billion and 130 billion. So with the tax rate of 15.5% to bring that cash back into the U.S., the hope is that these companies will invest in America, invest in their people. But skeptics say they have enough cash here in the U.S. as it is to invest. So will that really happen? We don't know.
Well, that's interesting. So, what do you think personally? Do you think these companies are going to bring their money back into the U.S.? I mean, we have some reduced regulations as well, right?
Yeah, I think some companies will bring the money back into the U.S. I think it's certainly a huge plus that the corporate tax rate has been lowered from 35% to 21%. And the AMT, alt-min tax for corporations, which was 20%, has been repealed altogether. So I think that's going to help, companies generate cash and invest. We're already seeing examples of companies paying their employees more, and general good corporate citizenship from a lot of companies. I think it's really going to require corporations to invest in the economy and invest in the U.S. Versus, skeptics that say they're just going to distribute the excess money to the shareholders. Individual tax rates too, Michael, if I can speak a little bit about that. Yeah. Under the old law, 39.6% was the highest rate. Now we're at 37% with the highest marginal tax rate at $600,000 for married and $500,000 for single. But some of the things changing at the individual level are pretty dramatic, such as interest deductions for individuals on their primary and secondary residences are only allowed up to $750,000 of mortgage versus $1 million under the prior law. And additionally, what's going to be painful for a lot of Americans is that you can no longer deduct interest on home equity loans, which you were able to under the prior law. But I think, with the reduction of the rate, and the standard deduction is going up from $13,000 to $24,000 for married couples. So, that's going to be a good thing. to raise that deduction. The other thing that is going to be particularly difficult for individuals is the limitation on property tax deductions, limited to $10,000. So if you're living in a high cost area, high cost state, my personal property taxes will be limited, and I think a lot of Americans will be. And the other thing that's going to be painful is zero deduction for state and local income taxes. So whatever taxes you're paying in your state used to be deductible on your federal return, no longer. So states lobbied hard against that and did not win.
Yeah, well, that's interesting. So here we are, we're late into the first quarter. Are you seeing any impact yet? So let's take repatriation and the combined impact of the lower corporate tax rate. Are you seeing your clients yet adjust any decisions? Are they hiring more? Are you seeing unemployment improve?
Unemployment's, at the lowest levels right now. It's difficult to say whether this is having an impact on that. But we're seeing with our clients a lot of analysis that's being done, which I recommend to all real estate owner operators. You really have to do projections on your existing status and translate that to these new tax laws, because there are going to be a lot of strategy plays. I'll give you for instance, with the pass-through deduction, which is new, which is revolutionary. We haven't seen this before. LLCs and partnerships and S corps, which a lot of real estate is owned in LLCs and partnerships, and even sole proprietorships are subject to a 20% deduction on what's known as qualified business income. And what is qualified business income? It's generally all your income from your business, not including interest, dividends, capital gains. However, REIT dividends do qualify for this 20% deductions, as well as publicly traded partnership income. And that deduction is passed through to the owners of the business, the partners, the members of the LLC. It is limited to 50% of your W-2 wages of that business, or 25% of W-2 wages plus 2.5% of your tangible depreciable property. So without getting into a lot of calculations here, real estate entities stand to benefit because of the 2.5% depreciable basis limitation there. But it's really important to note certain entities do not qualify for this, Michael, such as service companies, accounting, law, health, actuarial, performing arts, consulting, athletics, financial services, brokerage, and leasing do not qualify for this. So a lot of real estate companies, Michael, are going to have income from multiple sources, some which qualify for this deduction and some which do not. So there's a lot of planning strategy that needs to take place.
Yeah, well, that's very interesting. And if you look at the reduced corporate tax rates alone, and again, we're deep into the first quarter, are you seeing any impact yet on real estate?
Well, there is a private equity fund that just announced that they're shifting to the corporate structure to save taxes. They were not in a corporate structure previously, and they're moving toward a corporate structure to save taxes. So I think we're going to see some activity like that, and obviously that's going to benefit capital to be able to invest in other places. The lower the tax rate, theoretically, the more cash companies are going to have to invest. I can't say we've seen it yet, because this tax savings is just going to start to happen. We're still in the first quarter, so first quarter reporting, and I think into the year when people are going to determine and budget how they're going to use their excess proceeds. Another big win for real estate we're seeing is the ability to exclude yourself out of the business interest limitations. So there's a 30% limitation on interest, 30% of adjustable tax income, which is basically EBITDA, and there's no grandfathering for 2018. So, companies that are heavily leveraged potentially will have their interest deductions limited. Real estate companies can elect out of that, and for small cost, depreciation lines will be extended, just a year or two if you make this election. But real estate companies will be allowed to deduct 100% of their interest expense. Bonus depreciation has increased from 50% on 20-year property, personal property, to 100%. So this starts in 2017. So real estate companies are going to be able to deduct 100% of expenditures placed in service after 9/27/2017. So that will impact the 2017 tax year, and that's for 20-year and below property, personal property. So everybody should take care of that.
Okay. And what about somebody who buys a building in 2018 and then they do significant CapEx improvements to it? How is that handled now, tax-wise?
Yeah, tax-wise, now if you've got CapEx and it's considered personal property, you're going to be able to deduct 100% of that, and that's a big bonus. The other thing is with carried interest, that's going to impact a lot of sponsors, general partners, fund managers. And as you know, Michael, we've talked about this before. Carried interest has been on the chopping block for a while. It did not get chopped, but what happened was it got extended, the hold period, to 3 years or more. So carried interest, a lot of real estate owner-operator, developers, sponsors generate a significant amount of income from carried interest. That's the profits interest that they're awarded for being the general partner. You have to hold the property for 3 years now in order to continue with capital gain treatment. It used to be 1 year, and it's still 1 year if you are, not receiving a carried interest and just have capital gain. But that's something to be careful of, all our real estate owner operators, because there's a lot of fix and flips out there that you may have a goal of holding a property for 3, 4, 5 years. But market dictates that you're going to sell it, or an investor dictates you're going to sell it in 1 or 2 years. Significant difference in taxable income to the general partner sponsor.
Yeah.
Not to the investor, but the general partner sponsor. However, I do want to add that the capital that the sponsor invested still is subject to the 1 year hold versus the profits interest.
Yeah, and that's a good point. You may plan to hold something 5 years or 7 years, then you may look at the cycle and see where we are in the cycle. You may see interest rates starting to rise. You may say, hey, it's time to do it. Well, you should want to look at the tax implications because things have changed. And and one of the things that you mentioned, David, was that you may have some inflation coming our way. So that may mean the Fed will continue to increase interest rates. So we're going to take a short break, but when we come back, we'll get David's opinion on what will happen with interest rates and what might be the impact on commercial real estate market. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.